Thanks, Nico. Sorry. All right. Good morning, everyone. My name is Stacy with Sacramento Steps Forward. And like Nika said, joined by the team here. We have Kadia on our team, Jessica, who is our new grants director, and then Liana, who's our consultant, who we've been working closely with and who designed this training. So we're really excited for you all to be joining us today for our asset and income calculation training. Next slide, please. So today we hope to be able to share how to determine and calculate assets, what deductions to include when calculating a household's annual income, and when to re-examine income and documentation requirements. This is a continuation of our previous training. So if you weren't able to watch that one, you can find that on our website under the rent calculation training. And I see someone has their hand raised. Jeremy, did you have a question? Accident, got it. Anyways, yes, feel free to ask questions along the way or put in the chat and we are happy to answer it for you. Next slide, please. Okay. So like I said, this is a continuation of what we had previously gone over in our rent calculation training. Today, we'll be starting with assets because returns on assets are included in a household's annual income. Next slide. So before we start, I just want to give some context around kind of where we're getting all this information from and how it's coming down. So the Housing Opportunities Through Modernization Act, the HOTMA Act, is a federal act that guides these rules that we'll be covering today. They recently introduced a new asset limitation for families that cannot receive benefits if they have over 100,000 in total assets or ownership in real property where the family could not live. Self-certification of assets under 50,000 is allowed. New rules govern how income is calculated. There's a new HUD form, which is the ROI, which you'll need to have the participants sign only once. And there are restrictions when an interim re-exam must be completed. For additional context, we typically haven't gone over this topic in detail. So today might be a lot of new information and we'll try our best to answer all your questions. But again, this is going to be relatively new for our COC, this information. But our rent calculation tool that we shared last time has kind of some of this outline, especially the deductions that we'll go over after assets. Next slide, please. So what are we talking about by assets? So the definition of assets has changed from what was previously known. It's now defined as the cash value of all family assets, except those that are specifically excluded. And we also now refer to this as net family assets. So HOTMA has added new exclusions, which we'll cover today, and reasonable costs in disposing some assets may be deducted. Next slide. So what is excluded when we're talking about assets? Some of these items are the value of your personal property. So medical devices, cars used for commuting, clothing, furniture, any cars and vehicles specifically equipped for persons with disabilities. And when we're determining what a necessary item is for personal property, we don't actually have a list because it is so, as you would imagine, very extensive. So HUD kind of defines it as this kind of broad definition of necessary items. And also what is also excluded is the value of non-necessary items of personal property. when they have a total value of that does not exceed 50,000. Again, families are allowed to certify if it's below 50,000 in assets. Next slide. So what is included? We typically don't see this, but we wanted to include it for reference. If a family has assets in sales, the value of any business or family assets disposed of by the applicant or tenant for less than fair market rent during the 2 years preceding the date of application or reexamination would be included. And this includes a disposition in trust, but not in a foreclosure or bankruptcy sale. For disposition as part of separation or divorce, this will not be considered to be less than fair market value if the family member receives consideration not measurable in dollar terms. In addition, negative equity in real property or investments does not prohibit the owner from selling the property or other investments. So this negative equity alone would not justify excluding it from your assets. Next slide. So now we'll get into how this applies to rent calculation. In general, income from assets is considered income. So if it's possible to calculate the actual returns from an asset, you would include that amount into the household income. If it's not possible to calculate the actual return and the net family assets are 50,000 or less, the imputed or calculated income from that asset is excluded. If it's over 50,000, then you must impute it or calculate it based on this current savings rate, which we'll get into in these next few slides. Next slide, please. So here are the steps in determining the income from assets that you'll want to include in the household annual income. You'll first want to determine the household assets, so excluding any value of necessary items of personal property and non-necessary items of personal property that doesn't exceed 50,000. Then you'll determine the value of the assets. If it's under 50,000, you would add the actual income from those assets to the household's annual income, and you only need self-certification for that. If it's over 50,000, then you would go to the next step, which is determining if you can calculate all of the assets. If you can't calculate the income from assets, then you would use the passbook rate, which we'll go over. If you can, then you would just add the income from the assets to the household's annual income. And for both of these steps, if you're over 50,000 in assets, you would need third-party verification. Next slide, please. So this chart lays out when to include the actual income and the imputed income. And as you'll see, it differs depending on whether or not you have assets less than or greater than 50,000 and whether or not you can determine the income from assets. Next slide. So we're going to get into examples, hopefully, to help cement this a little bit easier. So for this first example, we have Judy and her niece. They're applying for a unit. They have a savings and a checking account with $3,000 and $5,500, respectively, both with fixed interest rates. Is calculating income required for this example? And we say no, because even though it's under 50,000 in value, you are able to see that you can calculate both. You can calculate both incomes. So for the fixed rate of 0.05% and 0%, you see that there's $1.50 in annual income that you would include. Next slide, please. So in this example, these brothers both have bank accounts, one with a savings account and another with a checking account and a CD, all have fixed interest rates. So in total, their checking and savings account is over 50,000. So is calculated income required in this instance? You say no, because the total combined assets are 57,500. And although it's over 50,000, income can be calculated for all assets. So you would include just the calculated or just the annual income from assets, which is $38.50. Next slide, please. So in this scenario, we have Ellen and Roger who are applying for a unit. Their household has a savings account with the interest rate. They have a CD with an interest rate and an annuity. So is calculating income required? Yes, because the cash value exceeds 50,000 and the actual income from the assets cannot be determined. The annuity is the one that you can't determine the interest on. So you'll want to apply the calculated income by applying the passbook rate to the $10,000 from the annuity. So you would add up the calculated income, so the $40, and the actual income, sorry, the calculated income is the 10,000 times the passbook rate, which is 0.40%, which gives you $40. And the actual income is $37.25. That comes from the known interest rates of $7.25 and $30. And then you would add those two together, so the 40 plus the $37.25, and that $77.50 is the amount you would add to the household's annual income. Okay, next slide. Sorry, we have one more scenario for you, so hopefully it's starting to make more sense. So we've got Tony and Jen applying for a unit, and Tony has a savings account and a bond with a total value of 52,000. It also has a determined income rate. Jen also has a savings account and a fixed interest rate, but she also has a CD with a current cash value of $10,000, cash value of $8,000, sorry. So is calculated income required? We say no, because even though the cash value exceeds 50,000, since the actual income from assets can be determined, imputing asset income is not required. So in summary, the process is similar. It just depends on whether or not you can, one, calculate actual income from assets, and then two, if it's over 50,000 or under 50,000 in value. So in this example, right, everyone has a fixed interest rate. You can determine the actual income from your assets, so you don't need to apply the passbook rate. Does anyone have questions so far? I'm not seeing any in the chat. Okay, next slide, please. So this decision chart kind of ties it together to help you determine when to calculate income from assets using the passbook rate. So again, going through this, if your net family assets is below 50,000, you don't need to calculate anything. You just need to add up the known income from assets. If it's over 50,000, you have to determine if you can calculate income from assets on all items. If you can, just add up those known items. If you can't, that's when you would apply the passbook rate. So in summary, you are applying the passbook rate when assets exceed $50,000 and you're not able to determine the actual income from assets. All right, next slide, please. So now we're going to go into detail of what's excluded and not considered assets. I won't read through the entire list. On the left side here, we have necessary personal property that is excluded. As well as on the right-hand side, we have non-necessary personal property that's also excluded. But the key is that it has to be under $50,000 to be excluded. If it's over, then you would include it as an asset. All right, next slide, please. So here's an example of personal property assets. So the Adams household has 3 items of personal property. They have a checking account of $5,000 that earns 0% interest. They have a $15,000 recreational boat and a $3,000 engagement ring. So maybe I should have read through that last slide. So in this instance, thanks, Nika, just to make this example a little bit easier for you all. So just to kind of sum up on the left side, the necessary personal property, you have things like cars, common electronics, clothing, medical equipment, supplies, equipment for exercising. On the right-hand side, you do have recreational cars and vehicles, bank accounts, jewelry, collectibles, equipment, machinery, and items such as gems, precious metals, antique cars, and artwork. Okay, so next slide. If we're looking at what is considered personal and non-personal property, so he has a checking account of $5,000, a recreational boat, and a $3,000 engagement ring. The checking account is considered non-necessary personal property. Sorry, the checking account and the boat are considered non-necessary personal property with a combined value of $20,000. So that is under $50,000. Then you have the engagement ring, which is considered necessary because its jewelry is used in a religious cultural celebration or ceremony. And since the total value of non-necessary personal property is less than $50,000, the household's property would not be considered when calculating the net family assets. So we'll go to another example on the right-hand side. He has the same checking account, but it actually earns now 0.07% interest annually. And he still has a recreational boat and engagement ring. So the assets are still 0, but because he's earning interest on his account, his checking account, you would include that amount in the household's annual income. So it would be 5,000 times the 0.07%, which is $3.50. Okay, next slide, please. So we are going to cover some additional exclusions. Again, these slides have a lot of information, but we're including them here for your reference. So some additional exclusions would be federal tax or fundable tax credits for a period of 12 months after receipt by the family, a trust fund, any amounts recovered in civil action or settlement. And then again, negative equity alone would not justify excluding property or other investments from assets. Negative equity in real property or other investments does not prohibit the owner from selling the property or other investments. Okay, next slide. So this chart covers information on assets based on trust type. So you'll see depending on the trust type, it's very specific as to include or not include interest as part of the household's annual income. For example, the irrevocable trust in the middle here, you would not include any of the value in the family assets unless you're earning interest. And the distribution, or unless the distributions are used to pay for health and medical expenses for a minor. So it's very specific That's why we include these charts and these information. So if you have this situation come up with your household, you can refer back to these slides. Next slide. So we do have an example here, again, not as common. We have Cody, he's age 22, and he receives a periodic income distribution from his non-revocable trust established by his mom. Last year, they received $15,000 from the trust, and documentation verified $5,000 of the funds were distributed, was interest income, and $10,000 was principal. So in this example, we would only include the $5,000 in interest when determining annual income, and the principal amount, $10,000, is excluded. All right, next slide. So we're continuing more exclusions. This is actually a duplicate slide. My apologies. We already covered this. Next slide, please. The value of real property that the family does not have the effective legal authority to sell, interest in Indian trust lands, any account under an IRS recognized retirement plan, including an IRA, employer and retirement plans, or retirement plans for self-employed individuals, education savings accounts, family self-sufficiency accounts. And when assets are held in an individual's name, but the assets and any income they earn accrue to benefit someone else who is not a member of the household, and that other person is responsible for income taxes incurred. Okay, next slide. So how do we certify these? So if you have a family with assets under $50,000, self-certification is allowable. It must include any expected income from the asset, so actual returns. And again, it must be included in the family's income when you're calculating the totals for rent. No further documentation is required by the PHA for the net family asset restriction. For property ownership, self-certification that the family does not have any present ownership interest in any real property is necessary. Again, there is a form, and so this is the self-certification, and it would go into these details that your household will need to provide if they own property. Okay, next slide. Asset limitations. So, like we mentioned at the beginning, HOTMA has now enforced that families cannot receive your housing or service benefits or be in your program if they have over 100,000 in total net family assets or ownership in real property where the family could live. There are both limitations have exceptions to these rules. So things like age, disability, income, the ability of the family to find suitable alternative housing, and whether or not supportive services are provided can all be exceptions, which we'll go into more detail as well. The PHA can also delay this process so that families can get into compliance. So they can delay it for up to 6 months. Next slide. So here are some of the exceptions of ownership of real property. So if a family receives assistance for the property from the HCV program, manufactured home, or home ownership program, they would be exempt. If the property is jointly owned with someone else and occupied by the other owner who is not a member, so not a participant in your program, or they're a victim of domestic violence, dating violence, sexual assault, or stalking, you do have to self-certify that or have the household self-certify. or a family that's offering the property for sale. So all these instances would exempt them from that rule that they cannot receive benefits, even though they have property. Okay, next slide, please. Additional exceptions include a family that owns a property a property may not share that's suitable for occupancy. So for example, doesn't meet the disability related needs for the family members. It's not sufficient for the size of the family. It's located, so it'd be a hardship for the family. For example, if it's really a really long commute to work or school, or if it's unsafe. Also, if it's not a property that a family may reside in their local or state laws. So for example, a storefront that's zoned for commercial use only. All right, we are going to pose a question in the next slide to test you all. So a family is going through a reexamination and reveals that one family member recently inherited a house. Which of the following is true? You can check multiple answers. And if you want to participate, you can just put your response in the chat. So A, the inheritance is shared with a cousin who is not in the assisted family and currently lives in the house. The house is valued under 100,000. The house is in another state and moving would cause the family to lose their jobs. The house is ugly and requires some minor repairs. And sorry, I didn't read the full question. Which of the following could be true to allow the family to continue to receive assistance? See some answers popping up in the chat. B, A, C, A, B. A. Last call for any responses. All right, so I think we've got one who is fully correct. So the answer is A and C. So it's a dual response. So because it's shared with the cousin who's not in the assisted family and currently lives in the house, it's not considered breaking, or where they would have to no longer receive assistance because it's shared. And then the other response is that it is in another state. And I see folks got that as well. So moving would cause the family to lose their jobs and it would cause an undue burden. So that also is a reason for them to continue receiving assistance, even though they own property. Okay, thanks everyone who participated. Next slide. Okay, we have another one here for you. So we have Layla, she's age 60 and has a traditional IRA. She has a current balance of 100,000 and an interest rate of 3%. She has access to the full balance, but she has not taken out any payments. Is this a household asset? I'll give another 10 seconds if anyone wants to try.
some mixed
All right.
answers there.
Great job, everyone. So the response is no, because IRAs are not considered an asset. But we'll see in the next slide, we'll give you another similar scenario. So we've got someone who has an IRA, current balance 150,000, interest rate is 1.7, but he has already been taking out payments in the amount of 825. Is this considered an asset? Got yes, yes, yes. No. All right. 5 more seconds. Yes. Okay, so it's a bit of a, it's not a trick question, but it's trickier. So the IRA is not considered an asset still because it's a retirement account, but the interest that he is gaining from the IRA is considered. So the 825 that he's been taking out monthly, you would times that by 12 and you would add that to your household's annual income. So it's a little bit tricky, but great job, everyone. Okay, next slide, please. Okay, next we're going to go into deductions, and these these are items that you would subtract from a household annual income to get your adjusted income. It directly affects what your participant is going to pay in rent. And on your rent calculation tool, the tool that we went over last training, it does have all of these things laid out that we're going to cover. So it is there, but it's important to know what to apply. So just want you to know it's not something that you're having to create forms for. And like Leona said, there are resources that she put in the chat for some of these things we're talking through. So just want you to feel like, all of this is, it may feel new, but it's in the resources that we're going to be providing to all. So next slide, please. Okay, deductions. So HUD lists specific deductions that are allowable. We've got one for if there are dependents in the household, elderly and disabled families. It's only allowed once, this allowance per household. If you've been doing this a while, you'll notice that it has increased to 525. We have updated that in our new tool, so you don't have to go in and update anything. It's already there. Health and medical expenses, childcare expenses for children 12 and under. For this specific one, it cannot exceed the amount of income received by the person enabled to work, and it may not be deducted if expenses are it being reimbursed by another funding source. On the right-hand side, you'll see there is permissive deductions. This is only allowed if your public housing authority has it written in policy. So for now, we're only applying our mandatory deductions for our Sacramento COC. Next slide, please. So the dependent deductions, you would apply this rate for each household member who is considered a dependent, which here is listed as anyone under the age of 18, anyone who's attending school or vocational training on a full-time basis, or anyone who's over the age of 18 and who has a disability. You would not include the head of household or the spouse. Just want to note here that foster children are excluded for the reasons that HUD defines a dependent as someone who's dependent or relies on the head of household for financial support. Next slide, please. So additional deductions include health and medical expenses. For this section, you will have to consider the amount of annual income that the household receives. So this deduction applies to the amount that exceeds 10% of the annual income. So I'll go over what's eligible and then we'll kind of go through some examples of what we're meaning by this. So what is eligible is unreimbursed health and medical care expenses for elderly or disabled families, unreimbursed reasonable attendant care and auxiliary apparatus expenses for each family member who is someone with a disability. And this is really important to the extent necessary that it enables any member of the family, including the person with a disability, to be employed. So it can also not exceed the combined income of the adult family members who were able to work. Just a note here on the side is that this rate has increased from 3% to 10% through this new or updated federal regulation. Just more information, going into more detail on the right side. If you are interested in this, the deduction has the threshold has increased. This also may affect how much someone pays. They do have this kind of phase in exemptions, which we'll go over, and also the fact that we're increasing the deduction for someone who has a disability. So the head of household also may affect this, but we'll go over this in more detail. Next slide. So for health and medical expenses, this applies to participants that are either elderly, so at least 62, or there is a family member with a disability, which applies to all of our PSH projects because that's an eligibility requirement anyways. So this would automatically apply to every one of your households. And again, you can only apply this deduction once per household. Sorry, this is for health and medical expenses. I'm going into disability. So for health and medical expenses, this would apply to all PSH households because you do have someone, at least the head of household, who has a disability. So for medical expenses, you can include anything anticipated to be incurred during the 12 months following certification or recertification, which are not covered by an outside source. So it cannot be covered by insurance. And we have a list here of those expenses. So services or doctors, healthcare professional, services of healthcare facilities, dental, eye services, live-in assistance, monthly payment on accumulated bills. Next slide, please. So another category is the unreimbursed reasonable attendant care and auxiliary apparatus expenses details. It's a mouthful, but this includes costs related to enabling somebody to be employed. For example, it has to enable one or more family member to work. It cannot be reimbursed by an agency outside of the household. You can also not pay a family member, for example, childcare that's being offered by someone who lives in your household. And it cannot exceed the earned income of a household member enabled to work. So these things can include things like home care, housekeeping, errand services, interpreter service. Auxiliary apparatuses include things like wheelchairs, ramps, adaptation to vehicles, special equipment, anything directly related to allowing the person to work. And also want to elevate that this also includes childcare. Childcare that is being offered by a licensed professional. So it can't be childcare that's being offered, again, by anyone in the household or by, say, a family member who's not licensed in order for it to be reimbursed. Next slide, please. So in general, this federal law or regulation also allows for exemptions for these deductions. So there are 3 types that allow further income deductions, which include like a phased-in approach, which we'll go over in more detail, financial hardship, and continued childcare expenses. So next slide, please. Oh, sorry, can you go back one slide, Nico? I'm going to go through this in more detail. So the phased-in approach allows families to receive an exemption where they don't have to immediately start at that 10%. So it will go through like 5%, 7.5%, then 10%. And then the financial hardship is also sort of it's less of a jump to the 10%. So deductions exceeding 5% of annual income is applied, and you can use this up until the 90 days, but your program can allow for longer relief if the family hardship continues. And the continued childcare expenses also allows for extension, so 90 days to where you can provide that extended relief. So we're going to go through an example here next to explain what we mean. So this is an example of category 1, so the phased approach that we're talking about. So in this example, the family has an annual income of $20,000. They have unreimbursed expenses of $2,500. In the past, you would be able to reimburse, right, anything over 3% of their annual income. So that would have been $1,900 because, yeah, when you do the math, I'm not going to go through the math, you'll get $1,900 to be reimbursed by the old HOTMA rules. So under this new 10% threshold, 10% of $20,000 is $2,000, right? But they have $2,500 in unreimbursed expenses. So you can now only cover $500. That deduction has reduced, right? Has reduced a lot from the previous rules. So what HUD is allowing is there is this exemption category. So in year 1, they would still receive a 5% deduction, or sorry, anything that's over the 5% they would receive. So $1,500 would be applied as a deduction instead of the $500, which is a big difference. In year 2, you would increase that to 7.5% of their income, which is $1,000. And then it would get to the 10% in year 3, which is the $500. So that is allowable as an exemption for families that have a hardship. Next slide, please. So this is an example of category 2. So a family may have had qualifying medical expenses that did not exceed the 3% when the rule went into effect, but whose health and medical expenses have now increased and did not exceed the new 10% threshold. This family can receive temporary hardship relief if related expenses exceed 5% of the family's income. Another example is the family's related medical expenses have not increased, but the family has had a decrease in income or increase in other expenses resulting in financial hardship. So the family would receive temporary hardship relief if it's related to expenses that exceed 5% of the family's income. So on the right-hand side, it just kind of lays out what category 2 means in more detail. So it can include families that qualified under category 1, but exhausted that relief or chose to apply for relief under this second category in the second year of their receiving the Category 1 deduction. So in order for a family to apply for this exemption, they would demonstrate that they have this financial hardship. Your program would then help deduct the expenses, and then you would track it. And then once their year's over, or if they're applying for a different exemption, you would need to track when that's over. Again, it's up to 90 days unless extended, and then the family would be subject to the current threshold, which is the 10%. Next slide, please. In this other example, we're talking about extended childcare. So this family has 2 children, a 9-year-old and a 16-year-old who has a disability. They receive childcare, which is about $200 a week, and also care for their 9-year-old daughter, which is $125 a week, and care for their son, which is, everything's totaling $200 a week. But it's for childcare and disability care. So when we break down the total income, we've got $21,200. You're totaling the childcare expenses at 125 times 52 for the year. That's 6,500. Total disability is the 75 times 52 weeks, 3,900. And then you've got the total disability expenses, which again has to be less than 10% of your annual income. So even though they've got $3,900 in total disability expenses, you can only include the amount that exceeds the 10%. So the $1,780 is what you would include for your disability assistance. So you would add that to your childcare expense, which would be $6,500, but because it's capped at earned income, which earned income for the lowest earner is $6,200. So that's the max you can include. So total is $6,200 plus the $1,780. So $7,980 is your total deductions for this household. Any questions on this? Okay. So again, there are permissive deductions allowed, but right now we don't have any written that we're using. So just want to put this in here for a resource. Next slide, please. Yeah, and Liana did put in the chat a resource sheet that helps with these exemptions because it is quite complicated when you're getting into it. So you don't have to do everything manually, luckily. This form is the HUD form 9886 is just an ROI. So it's a release of information that you would have your participants sign for us to be able to, or for you all to be able to seek information regarding their income or assets. They only need to fill this out once, and it's for anyone who is 18 or older who is part of the family. Next slide, please. So when are you re-examining income? So again, this is kind of a continuation from our rent calculation training. A family can request an interim re-examination because of family income or composition change since their last examination. It must be conducted within a reasonable time after the family requests it or when you become aware of the change. So this is generally no more than 30 days. You also must conduct a full re-examination if the family's adjusted income is estimated to have decreased by 10% or more. HUD can establish a lower threshold for interim re-examinations that's more generous to the family, but as of right now, we aren't applying that. Next slide, please. So this is the process. The family requests a interim examination, and then You would want to estimate if the adjusted income has decreased by 10% or more. If yes, conduct the reexamination. And I think that's the same process we just went through. Next slide, please. So again, you would want to conduct a full reexamination if it's increased, if the family's income has also increased by 10% or more. One thing to note is that you don't have to consider earned income when you are estimating this increase. So when you're calculating if it's 10%, you don't have to include the earned income. The COC can choose not to conduct an interim reexam for increase in the last 3 months of a certification period. So for example, if a family reports an income composition change in a timely manner, the rent decrease will be effective first day of the month after the event. So say your household loses their job on October 12th and reports their income loss on the 13th, their rent decrease would be effective that following month, so on November 1st. If the family did not make a timely report, the rent decrease would be effective first rent period following the completion of the reexamination. So a little bit later. Next slide, please. I'm going to try to speed up. I know, like, coming up to time here. So again, effective date of the rent increase, if they comply with reporting, do it within 30 days of their notice. If they don't comply, initiate a reexamination and implement any rent increase retroactive to the first month. Next slide, please. Okay. I'm going to skip these because we only have a few minutes and we're not close to done yet. So if we could go to the next slide, please. All right, I'm going to hand it over to Kadia, who's going to try to close this out quickly. Sorry, I didn't leave a lot of time for you. You're on mute, Kadia.
Of course. Putting it all together is what we'll be going over now. Everything that Stacy just went over, we'll be going over. Next slide. So this is going to go over documentation requirements. Next slide. Okay, so building on what we've covered so far, let's put it all together to ensure compliance. So we're going to start with this tenant file content. So every file must include the income worksheet and initial income verification documents. These are the foundation for eligibility and eligibility. Don't forget the subsequent income worksheets and their verification documents, as income can change. We have to include the rent calculation forms for both initial and subsequent periods, plus the utility allowance sheet if it applies. So attach the utility allowance letter if that does apply, that was sent to the tenant. Unit information and payment related documents. You'll need to include any notices of rental assistance and any subsequent changes to show that you're accurately keeping track and properly keeping tenants informed. You'll also need rent reasonableness documentation. It's very crucial to ensure that you're doing fair pricing. And just make sure you always attach the lease agreement and don't skip the inspection forms to confirm the unit meets standards. These elements ensure we're accurately tracking the financials and supporting our participants. Remember, thorough documentation protects everyone involved and aligns with our guidelines. You can move to the next slide. So this is billing expectations to SSF. So before submitting any billing to SSF, make sure that the rent calculation is fully completed and ensure this calculation was completed before the client moved in. You want to perform internal reviews to double check accuracy. Accuracy is key to compliance. So just be sure that you have signed, that the lease agreement has been signed with the landlord And that should complete your checklist for the final step. This happens before the billing. So these pre-billing checks help streamline the process and reduce rework. Remember, this is all under SSF's monitoring framework. So if you're handling these files, prioritize organization. It's what keeps our programs running smoothly. For billing submissions, certain documents must be provided upon our request. So this would be proof of rent payment to the landlord. So for example, it would be like a canceled check, the lease and reasonableness, I can't talk today clearly, reasonableness form. Provide the initial rent calculation form with unit infos such as size, rent, amount, and tenant portion. For recertifications, we'll probably ask for submitted updated rent calculation forms with the same unit details. If the utilities are involved, include proof of payment to the utility company. Again, this could be like a canceled check, plus the utility allowance calculation if applicable. This ensures transparency and verifies that all the payments were accurate. Insurance, these requirements tie back to the HUD and SSF guidelines. Keeping these organized will make monitoring and billing a breeze. Next slide. So diving into income documentation, these are standards starting with third-party verification. This involves contacting sources like employers, Social Security Administration, or public assistance agencies to verify income. It provides independent confirmation and helps anticipate any changes in circumstances. So always get written release from the households to authorize this. It must for privacy and compliance. It's a must for privacy and compliance. However, some providers might be unwilling or slow to respond, so plan ahead. This method is reliable but can take some time. Under these new rules, agencies need to verify income. It provides independent confirmation and helps anticipate any changes in circumstances. Always get a written release from the household to authorize this. It must for compliance. However, I'm saying the same thing over again. Unwilling to slow to respond. Go ahead. You can go to the next slide. Okay, so this is income documentation for source verification. So verification documents are provided by the applicant. These are like pay stubs and tax returns. This is easier to obtain because it is coming from the applicant. So you'll be able to get those other than third-party verifications, because those again take slower. May not provide all necessary information. So these might lack like might not have all the hours worked if they did overtime. Sometimes pay stubs don't show those. So you must get those actual things. Sufficient information about average number and hours worked overtime, tips, and bonuses. Sorry, I'm like all mumble jumbled today. Next slide. Okay, so when no other methods are work, self-certification or family certification can be used for income documentation. This might involve an affidavit, like when someone attests to having no income source, it's easier to get than third-party verification, but when no other methods work, self-certification or family certification can be used for income documentation. Whoa, this is crazy. It's only a fallback. Your file must show attempts to obtain third-party info first. For instance, documenting zero income could require a signed statement from the individual. This aligns with our new guidelines and standards, ensuring we cover all bases in the COC program. Use it sparingly and always back it up with evidence of your efforts. This completes our income standard section. Next slide. These are some key resources. This will be in the training slides that you'll get after. So please go ahead and check some of them out. She included some calculating rent and occupancy charges, COC at a glance virtual binders for rent, formulas. The leasing COC at a glance virtual binder covers lease best practices. For operating costs, refer to the dedicated binders. Don't miss rent reasonableness and fair market rent under the Continuum Care Program for pricing guidance. And for utilities, see the notice CPD 1711 on HUD Exchange. It details participant rent, contribution, and reimbursements when they're responsible for utilities. And that's it. We'll pause for questions and
All right.
answers.
Thanks, Gideon. So the rent tool and all the forms that we listed are also available in the portal. So in the portal's library, if you don't have access to that, just let us know and we can give you access. Sorry, I ran over a little bit of time. I'm going to leave it open for a minute if anyone has quick questions, and then if not, just feel free to send it to us via email. We can definitely respond. So does anyone have any last questions or things they want to mention?
Which email should folks be submitting to these questions?
That's a great question, Nika. Right now we don't have a shared inbox. We're about to send an email out with one, so keep an eye out for that. But in the meantime, you can just email it to me, Stacy. I can put my email in the chat. All right. Again, thanks for hanging on a little bit longer. We will send out these materials after the training, and yeah, we look forward to seeing you in another one. Have a good one, everyone.